This is InvestTalk. Independent thinking, shared success.
Hi, guys. Great show. I just wondered what you thought of the PIMCO Dynamic Income Fund as a dividend play. Okay, thank you.
The PIMCO Dynamic Income Fund, I think this is the third question or so in the past 6 weeks that at least I have answered. And the reason why we keep getting this question is because of the last 12-month distribution yield here, 15.64% on the PIMCO Dynamic Income Fund. Just as a refresher, the fund seeks current income as a primary objective and capital appreciation as a secondary objective. They look to do that by doing a dynamic asset allocation across fixed income and global credit sectors. It's a $6 billion fund. Its return has been pretty solid over the past year or so, especially relative to its index, which is the Bank of America Global Fixed Income Markets benchmark. But if you recall, this is a closed-end fund, not an open-end fund. An open-end fund is what you're used to with your SPYs, your typical ETA, your Qs. And essentially the way that works is when you want to buy or sell something, that share is either created or destroyed, and you're buying directly from the fund itself through authorized purchasers, but that's a little bit too complex. So just think about it, the share is being created for you and destroyed when you sell. Now, a closed-end fund is kind of like trading a company's stock. There is a certain amount, and you're buying it from somebody else, not directly from the fund, meaning that unlike open-end funds that typically trade at their net asset value, the value of everything that they hold, closed-end funds can trade at a premium or a discount. This fund trades at a pretty decent premium, usually between 7 and 12% is what I've seen over the past couple months. The reason why is because it is managed by PIMCO, because there is such high demand, because there's such high yield, again, and yield can change, you pay a premium to hold this fund. And so would I pay the premium just for the higher yield? Probably not. It's a pretty steep premium, meaning that if there's a lot of sell pressure, you could find yourself losing a lot without the net asset value of the fund itself even going down. So understand the dynamics of this fund, understand what a closed-end fund is. Maybe it makes sense for you. For most people, probably not looking to pay the premium that exists right here for the PIMCO Dynamic Income Fund, ticker PDI. Looks like we got our first live call. Lucy from New York. How can we help you?
Hi, I just wanted to ask you about the stock ticker AMD. I've seen it go to about this price twice in the last 18 months, and both times it dipped down again afterwards. I was just wondering, do you think, is there something different that's happening right now, and what would be a good entry point to purchase this stock?
Sure. AMD is Advanced Micro Devices. They are a semiconductor company. They make GPUs, AI accelerators, DPUs, all sorts of products that have really fit in with the secular growth theme over the past 2.5 years. Now, over the past 52 weeks, they're up 26.97%. Over the past 3 months, they're up 84.72%. And sales have been growing pretty quickly, although leveling off after 2023, but still 30.8% annually over the past 5 years. Now, this stock can oscillate between pretty expensive and very expensive, right? Right now, it's sitting about 34.4 times forward-looking earnings. The high is 64.5 times forward-looking earnings. But I think what you're seeing with this price action right now is just some tailwinds from that secular growth theme and some pretty positive earnings out of other areas of the market. You saw AMKR, who released earnings up 18% today. A lot of the semi space is still seeing record spending. And so that is in anticipation, therefore, of what hopefully investors would like to see out of earnings on August 5th here, right? There's not really much to the movement in price, 2.18% today, other than anticipation of elevated earnings. Now, this is a situation where these names are priced such that disappointment in earnings can be pretty catastrophic to pricing, right? You've seen historic levels of CapEx across the board, historic levels of spending that have really benefited these names. That's why you're seeing revenue climb like this. Now, this name doesn't really have the margins NVIDIA has, right? We're sitting at about 6.4% net margin, projected to be about 20% this year, but still nowhere close what the leader in the space has. I think for me, this name is a little bit too expensive with slowing growth relative to what you're seeing across the industry. And that's probably because it has had such a ridiculous run up over the past 3 months and put itself in a position that any meeting of expectations or miss on expectations, again, leaves a lot of downward pressure here. So I would say for this particular name, not the space in general, but for this particular name, a lot of risk to the downside heading into next week, where we will be seeing earnings on August 5th. Certainly, if I were looking to open a position, I would not do it before then. That's not to say that the stock price might not climb if they do beat, but this is a risk reward situation here. And for me, with this type of valuation, this close to earnings, the risk of getting in now a little bit too high. Thanks for the call.
Hey, good morning, guys. I'm looking for advice on VTGN Therapeutics as a speculative play, ticker symbol VTGN. The company specializes in intranasal products for psychiatric and neurological disorders. It has 5 drugs in the pipeline, 1 in phase 3 with positive data, and the remainder in phase 2. It seems promising as a newer concept, of course, if it works, and insiders have been purchasing more shares recently. I acknowledge it's like buying a lottery ticket, basically, but just looking for your thoughts on the current state of the company and anything else you can add. Thanks for all you do. Have a good day.
VTGN Therapeutics is a late-stage biotech company in that they have 1 drug in phase 3 and a couple drugs in phase 2, focusing on CNS disorders, social anxiety disorders, depression, menopausal symptoms, and cognition. And their lead drug candidate, fasedienol, is in phase 3 trials with results expected in Q4 of this year. Now, they have had some positive data come through about this drug. That's why it's up 33.62% over the past 3 months. There's some optimism around clinical trials, which has really led to this insider purchasing. And you see some pretty strong momentum, right? You see some strong momentum in this name over the past 3 months. But at the same time, it is still a pre-profit company. Right? So revenue is very low. Net margins are in the negative 7,000 range where it's projected to be this year. And so it is exactly what you said it was when you called in. It is a lottery ticket. Now, I don't know if this drug is going to be successful. There are plenty of drugs that get through phase 2, get to phase 3, don't do well, and then we move on. And so if you wanted to put a little bit in here as a lottery ticket, I wouldn't call it investing, I would call it gambling. And we as an investing show don't usually recommend throwing money into these pie-in-the-sky biotech names. One of them will hit, but it doesn't necessarily mean this one will be the one. That is VTGN Therapeutics, ticker VTGN. Every day now, we receive questions from the comment section of the InvestTalk YouTube channel for our growing audience of viewers. And when you leave one, we like to get to those as quickly as we can. This question is from our friend Peter in New York. It says, longtime listener and truly value your opinions and philosophy on investing. I would like to invest in the nuclear market, but trying to pick one potential winner seems so risky. I looked at the ETF NLR, which has holdings all across the nuclear power chain, including miners to utilities, operating power plants. What are your opinions on some of the core holdings in this ETF? Thank you for your insight. Well, NLR is the VanEck Uranium and Nuclear ETF. It holds a pretty narrow portfolio of companies involved in the nuclear energy industry, ranging from big industrial conglomerates to uranium miners. Eligible firms have to have at least 50% of their revenue from the uranium and nuclear segment. It heavily overweights utilities and carries a little bit of weight in energy, giving it a large cap tilt. It's about $2 billion with a 56 basis point expense ratio. Year to date, it's done pretty well, up 45.68%. Relative to a benchmark about 44.92. The reason why uranium and nuclear have done so well is because the anticipated high energy demand going forward and the necessity to diversify our grid, and not just in the United States, but globally as well. Now, as it mentioned, there's a little bit of large cap bias here, about 42.56% in large caps, about 29 in mid caps, about 26 in small caps, and as promised, a lot of utility and industrial weight in this fund. Now, the big names are exactly the ones you would expect: Constellation Energy, Cameco, which we hold for our clients, Uranium Energy. It's pretty broadly diversified across these. Interestingly enough, right, I'm looking at about the top 10 makes about 55.1% of the benchmark, which leads me to believe that there's got to be some sort of capping in here, because I'd imagine that Constellation Energy and Cameco would be a higher weight here if it was uncapped. Let's take a look. Index selects and weights holdings by market cap with individual weights capped at 8%. There it is. So there's a market cap weighted fund capped at 8%, meaning you're going to get more small cap exposure. So this is essentially a nuclear uranium ETF that is tilting towards those smaller names because of the effective cap here. I think this is a pretty solid way to approach the sector. It gives you broad diversity, focusing not just on utilities, but also on energy, also industrials. Again, broad way to go with the theme here. And I think generally speaking, the broader you can get on these themes, the more net you can catch here, the more beneficial it can be for you as an investor. So 56 basis points actually sounds pretty reasonable to me here, because they're not really just doing a set it and forget it easy methodology. There's a little bit of active management here, even though I imagine they only rebalance periodically. So if you're looking to get some broad exposure to uranium and nuclear, I don't see any problems with the VanEck Uranium and Nuclear ETF. All right, looks like we got another live call from Rob, who's listening on AM 1220, and has a question on LNW. Do you own it, or are you looking to buy it?
I do not own it, but I am interested in it. I'd like to know what your thoughts are, Lou.
Well, what interests you in the name?
Well, I know they're big into the whole gaming thing, which I know absolutely nothing about, but I know that it's certainly a huge market, and they seem to be capturing some of that market, and looking at a 3-year chart, stock has done pretty well.
Yeah, so let's dive into it then. It's pretty good bullet points there for me. Light and Wonder, formerly known as Scientific Games, they design content and hardware for land-based casinos, online gaming, and social casino games using their SciPlay and iGaming segments. Now, over the past 3 months, it's up about 15.03%, outperforming its industry each of the past 6 years, which is actually pretty impressive here. Revenue growth, though, has fallen from 2019. It did really struggle during the pandemic. Revenue fell to $2.1 billion, and it's since climbed its way out there, almost back to that pre-pandemic high of $3.4 billion, projected to be $3.43 billion this year. At the same time, right, it lost money pre-pandemic, just positive in 2021, but margins started to expand in 2023. And they keep expanding. Net margin projected to be 13.9 this year. Now, over the past 3 months, it's really been driven by the announcement and implementation of this multi-year cross-platform revenue plan, something that has actually shown itself, it looks like, in recent quarterly earnings. Q1 earnings did beat on revenue and earnings per share, and we're approaching Q2 earnings now on August 6th. And so, keeping that in mind, right, it's trading at a relative valuation that seems pretty reasonable, 15.7 times forward-looking earnings, only about 2.7 times sales at about its averages. From a technical perspective, seems pretty okay. I wouldn't say it's in a general uptrend or a downtrend. It's kind of been ranging for about a month on the back of some, again, good earnings earlier this year. I would give the advice that, that in general, which is as we approach earnings for companies, it's best to stay out, because empirically speaking, the historical returns of buying before earnings is negative. Now, that doesn't mean that every company's return is going to be negative after earnings. It just means that you're kind of throwing yourself in a pot at a time when people are trying to assess the fundamental value of a company with new information out there. Now, I do like the turnaround program from this name. I do like its emphasis on this cross-platform content. And I do like that its margins and its cash flow have been consistently expanding for a couple years as they've been buying back shares. So overall, I do like this name. It's at a relative valuation that seems reasonable, but I would still wait to see how earnings shake out in the next week or so, just so you're not just in there with a bunch of people betting on the direction of earnings. That is Light and Wonder, ticker LNW. Thanks for the call, Robert. Now, Justin and I briefly mentioned it yesterday, and I talked a little bit about it last week, but I think it's important to put it in the context overall of what is happening in the market. Now, if you were listening to Friday's show, you would recall the acronym that is now being used to describe the new meme stocks, which are Krispy Kreme, Open Door, Rocket, and Kohl's. And due to their tickers being Donut, Open, Rocket, and KSS, Dork, the new meme stock group driven by retail investors, because they're being targeted by short sellers. You saw massive price movements. You saw Open Door surging 500% in July before falling back, right? Showing the speculative nature of that trade. And it really is, once again, what we saw during the GameStop era of retail investors organized in some fashion on social media sites like Reddit, attacking their hated institutions, hedge funds, because of the amount of shorts they have in these names. But this isn't the only thing I want to highlight about the speculative nature of today's markets. It's not just meme stocks. Goldman Sachs has noted speculative activity is approaching the dot-com era levels and the stimulus levels of 2021. 0-day options are surging, meaning people are purchasing options that are expiring the same day. They hit a record volume of 2.1 million trades in Q2 of 2025, with retail making up half of those trades. And it's not because of stimulus checks this time. Unlike in 2021, when stimulus checks are gone and Fed policy is tight, or at least tighter than it has been for the last decade, yet retail speculation is still on the rise. Retail makes up about 20 to 25% of all trades right now. That is down from the 2021 number, but still well above the pre-pandemic norm, which ranged between about 10 to 16% of overall trades. So why is this happening? Why is this speculation happening? If it's not that we're just getting free money thrown at us, that is, if it's not because Fed policy is very loose and the money supply is fluid, a lot of it has to do with tech-driven access. App-based brokerages like Robinhood, which is up over 150% year to date. What's Robinhood up? It's up 177% year to date. They've democratized leverage and micro investing for the masses. You have everything accessible in your phone anytime you want to make a trade. Now, in some ways, even after normal trading hours. JP Morgan is seeing a shift. Even low-income households are now investing more, with participation quadrupling since 2015. But the problem isn't that more people are investing. The problem is that more people are speculating. More people are gambling. Investing is not buying Krispy Kreme and Kohl's. Investing is not trying to take advantage of open interest, hoping that there's going to be a short squeeze and you are the beneficiary of that. Because the reality is most retail investors, ask those who invested in GameStop, are still left holding the bag. It makes the market structure all the more fragile. Cliff Asness from AQR warned that retail speculation is damaging market efficiency. And we haven't really even seen yet how it operates in a true downturn. Certainly, the risks out there are greater when more money is flowing to things that don't have as much fundamental value. Just because you can trade from your pocket doesn't mean that you should. All right, let's keep things moving and try and tackle this caller question before the break.
Hey, Luke and Justin. This is Louis calling from Peru. Hope you guys are doing well. Thanks for all you do to help us with our investing questions. I went online and just looked up a compound interest machine, I guess you would say. And if you put $50,000 in today and it averages 8% a year and it's compounded monthly, you'd be looking at like $367,000 in 25 years. And the payout that year would be $29,000. So is that type of analysis fair, or am I missing something? Thanks so much for your time, and I'll be listening on the podcast. Have a great day.
So I think what you're looking at is the power of compounded interest. Meaning if you're getting a return, in this case you're doing it monthly, and it's compounding, meaning that you get returns on your returns, how is your money going to grow over time using 8%, which is a reasonable long-term return based on the historical returns of the S&P 500 over longer periods of time? And so it is fair to say that based on that 8%, you start with money here, you end up with all this money down the road. But that's not necessarily going to bear itself out in reality. You could have invested that money for a long period of time, and the end of the road was in January of 2009. And what happens then? Well, you compounded, but the timing is such that the market crashed, and you don't end up with that pile of money. And so over longer periods of time, yes, you can try and make these assumptions that help to understand the power of investing. But so much of investing is something we can't control, which is market timing. Don't think your money will compound at 8% over time, and that what you save today will exactly be what you expect it to be in the future.
Hello, Luke or Justin. I'd like to hear your opinions on the high-quality business of Adobe. It seems like the sentiment for the business is going in opposite direction of the financials. And there's growth in the business, there's value. And I feel like at the current price, there's far more reward than there is risk, unless there's some new risks that I'm not seeing. Please share with us if you feel like today would be a good day to buy it, because I'm really getting close to it. And I think that there's a significant misprice in the market today. Thank you.
Adobe Inc. is a software company, global technology company, mainly for digital marketing and media solutions. Now, year to date, it's down 16.64%, down 30.92% over the past 52 weeks. And in the wake of its earnings 3 months ago, it is flat. It's underperforming the industry by 35.5% this year, underperforming the S&P 500 by 25. It's had a rough couple years. And the reason why is because it hasn't really done a good job integrating AI into its platforms, number one, and because of competition. And that's always been my issue with Adobe over the past couple years, is that it seems to be the easiest business to enter given the advancements in large language models. Now, you do have IPOs in the near future, Figma being one of them, that should maybe buoy the valuation of companies like Adobe if the market is willing to price new entrants at a higher level, but it could also work in the opposite direction as well. I think, yes, they have had positive earnings, but just barely beating consensus, not enough to offset some of those broader structural concerns within the industry itself. And so I think that right now where it's trading, which is about 16.6 times forward-looking earnings, although it's at a low, really is just incorporating the risks and the threats of new entrants to Adobe's business. That is ADBE Adobe. There's been a lot of talk about crypto recently, and anytime there is talk about crypto, well, the risks start to rise as well. And in this case, it is in the form of lending. Crypto lending is back in spite of the uncollateralized loan crash that collapsed the crypto market in 2022. This company, Divine, has issued 30,000 uncollateralized loans since December, mostly under $1,000 in USDC stablecoins. Borrowers are everyday people. They're targeting low income, underserved populations, people that may not have access to financing. And so it's essentially what they have dubbed microfinancing on steroids. But subprime lending, if you will, comes at a cost. Divine's charging 20 to 30% in fixed rates. 3Jane, another company, offers unsecured lines on Ethereum. They're backed by the same VC firm that also funded FTX. I think one of the big issues here is, yes, there is investor demand for this. Yes, there is borrower demand for this. Startups are funding these loans, right? More companies are appearing every day to fill this investor demand and this consumer demand. But there's some enforcement risk. There's some regulatory risks. There's some real risks here to the financial system broadly. We saw in 2008 what happened when under-collateralized debt became toxic and proliferated the financial system. But even back then, there's a lot of hoops to jump through in order to get a mortgage that you should not have had in the first place, albeit there weren't enough. There was not enough checking of credit quality. But the big problems in financial markets and in economies happen when debt becomes toxic and proliferates. And so I'm watching this cautiously. Wall Street is watching this cautiously, albeit JP Morgan and Cantor Fitzgerald trying to enter this space. But the risk-hungry VCs are surging ahead. And so understanding the risks that are out there can help you position your portfolio to better make it through unfortunate downturns. I'm Luke Guerrero, and this completes another InvestTalk program. If today's show made you think about your own financial picture, if you think you might be exposed to more risk than you otherwise should be, if you've been thinking about your taxes, if you've been thinking about estate planning, at KPP Financial, we can help you with a no-cost portfolio review. It all starts at investtalk.com. Just click the portfolio review button. And while you're at it, if you want to tell one friend, just one friend or family member about InvestTalk and have them join the family, we really would appreciate that as well. Get your downloads at Google Play, Spotify, and iTunes. Independent thinking, shared success. This is InvestTalk. Good night.